as you know, or I believe you know, today is Tuesday. Oh, let me get this a little closer. Today is Tuesday, February 4th. This is the meeting for Budget and Finance Committee. I am Christine Novello. I am the Rec Centers of Sun City West Governing Board Treasurer, as well as the chairperson of the Budget and Finance Committee. Today, as you may have heard from Carl, we do not have speakers in the room. Our loudspeakers are being repaired right now. So thanks for sitting nice up front and close and cozy. Isn't this nice? So again, I'm very pleased to call the meeting to order. And we always start with a Pledge of Allegiance. So if you're able to stand, please rise and join me. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you again for being here. We are live streaming as usual. If you're here on our live stream and watching, you are free to make comments in the comment box. Use as many boxes as you need. I will start by establishing the quorum. You can see visually that we have all members of the Budget and Finance Committee present physically, so we certainly have quorum this morning. I'll move on to our meeting procedures. The governing board and its committees conduct all its meetings in compliance with Arizona Planned Community Association open meeting laws per ARS 33-1804 and in concert with RCSCW bylaws, policies, and standing rules. Parliamentary procedures as outlined in the most recent edition of Robert's Rules of Order will also be followed in all meetings as appropriate, consistent with Bylaw 3.07, Procedures for Owner-Member Meetings, and Standing Rules number 2 and number 3. This would be also a good time to remind you that this would be a good time to silence your cell phones. It's a reminder for myself as well. I'm going to just take a quick look and make sure that I've done that. I do it all the time, so I'm not making fun of anyone. So again, moving on. If you're, you can see, hopefully you can see all of our names on a placard in front of you. We've made our introductions in our September 3rd meeting, so if you'd like to know more about the Budget and Finance Committee and its members, please go to that meeting, and you can learn more about the members and our background. We'll start with number 2.01 in our agenda. Our meeting minutes from January 21st, 2025. So committee, any revisions or concerns? Okay, seeing none, we have consensus, and we'll move forward to new business. We're going to start with our quarterly Q4 review of our reserve fund performance, which will be led by our investment management firm, CapTrust. So I'm pleased to introduce Carol Romney and Nathan, who will come up and give us an overview of our performance and an outlook for the future. Nathan, I believe you'll kick us off. Cliff, is there anything that you would like to do in the way of introduction as well?
Sure. So Nathan Erickson, I'm a principal financial advisor with CapTrust. I think we've been managing these funds for close to 4 years now. That's correct. So we've been around for a while. We definitely appreciate working with all of you, and we'll provide some economic context first, and then Carol will talk about performance. Let's see if this works. It does. So just a recap first of broad market performance. So these are major asset classes. The shaded bars represent the fourth quarter. So it was a bit of a challenging fourth quarter. As it relates to the Sun City West portfolio in particular, the bond market was down 3.1% in the fourth quarter. We'll talk about why in a moment. But generally, all asset classes, again, relevant to this portfolio, were positive for the year. U.S. large cap stocks up 25%, small cap stocks up 11.5%, emerging market stocks up 8.1%, and then developed international 4.3%, with fixed income up 1.3%. Carol will go through the asset allocation of the portfolio when she covers performance, but those are the asset classes represented in the portfolio. I mentioned fixed income. The primary driver of the fourth quarter loss was a material move in interest rates between September and December. So you can see at the end of September, the 10-year Treasury was at 381. At the end of December, 458. So almost 0.75% move in a very short period of time. And when interest rates move up, the value of bonds goes down. And so that was the driver of the negative performance in the bond index. We performed a little bit better. The cause for that move in interest rates had a lot to do with the election of the new administration, concerns around inflation, and ongoing strength in the U.S. economy. We cover here some headwinds and tailwinds as we look ahead at the broad economic outlook from a headwind standpoint. Some continued unknowns as it relates to the pace of the Federal Reserve and their interest rate policy. I'll show you a slide in a moment, but that has changed again with some of the new data that's come out in terms of the strength of the economy. So, the market is keyed heavily on whether rates are moving up or down and the speed of that. Some pressures related to policy. So we've already seen, especially this week, the beginning of this week, tariffs that have been announced, some changes in immigration that can have an impact on inflation as well as cost of wages as we look at the labor force in total. And then fiscal decisions relates to the fact that we've already hit the debt ceiling in this country. So we have passed the amount of debt allowable by Congress to be issued. The Treasury has ways to work around that. So we have some time, probably until May or June, before that becomes a major issue. And as we've seen in the past with debt ceiling issues, it can lead to suspension of government pay. So that's something that will need to be addressed. And lastly, just the housing market continues to be relatively frozen with high interest rates and people unwilling to move, as well as a lack of sufficient housing in this country. On the tailwind side, we do have an administration that is very growth oriented, so deregulation, increased tax cuts, supportive of growth overall within the economy, so that can continue to be a positive force. If you follow the stock market at all, a lot of the performance lately has been concentrated among a handful of stocks or among the technology sector. So some expectation that profitability will broaden across more sectors and more companies. And then the expectation that artificial intelligence will continue to contribute to productivity gains overall. I mentioned the Fed's pacing and direction. So this is a chart that tracks the federal funds rate, the overnight rate that banks borrow from each other. Going back to 2020, we had 0% interest rates. COVID hit, we had a very substantial increase in rates in a very short period of time. That was a challenging time to be a bond investor, and we saw that in performance. And then here's where we sit today. These two dotted lines represent the market's pricing of expectations in September. So in September, it was pricing in that in 2025, we'd see about 1.5% of rate cuts. And then in December, after the election, continued strong growth numbers, it's now pricing in about 75 basis points of rate cuts, with the first one unlikely to happen until mid-year. So, and those data points can change. In fact, this same source, which is the CME FedWatch tool, you can see at the bottom here, is actually pricing in a very slight chance that we see an increase in interest rates at mid-year. So we continue to monitor the data there. Another concern that the market is aware of and paying attention to is the level of debt relative to GDP. You can see we've now hit on a ratio basis levels we haven't seen since World War II. So that's an ongoing concern. A couple of ways you can address that: spend less. So if the Department of Government Efficiency is effective at reducing spending, that can reduce this ratio. The other is to grow your way out of it. So if we do see productivity gains coming from artificial intelligence, that could help GDP growth increase at a quicker pace and also address that. We don't see this as a immediate problem because of the fact that the US dollar is still the reserve currency. There's not really an alternative to that. So the market isn't currently punishing the U.S. for its high levels of debt, but it's something that could happen if there becomes a viable alternative or if it continues to grow at an unmanageable rate. Just briefly, as it relates to the equities, equity market, you may have heard of the Magnificent Seven stocks, these 7 stocks that are representing now 33% of the S&P 500 that have contributed to half of the performance over the last several years. They're listed up here. Familiar names. You can see since over the last decade, they've grown from about 11% now to just over a third. Valuations are quite high among those stocks, trading on average about 40 times their earnings rate. But this is our concern, to the extent you have equity exposure, is that it is very concentrated. And so if those stocks are doing well, the market's doing well. If they're not doing well, it works the opposite direction. So something to keep an eye on. I mentioned a course of, potential tailwind for the economy is deregulation. You can see the differences in regulatory spending among the Obama administration in the first term, Trump's first term, and then Biden most recent term. So the expectation is we will see this number come down materially somewhere around where it was during Trump's first term, and that again would be supportive to more economic growth. As it relates to tariffs, my comments on this has changed over the last couple of days, obviously, since now these are actually in place. But the U.S. imports 40% of its goods between Mexico, Canada, and China. So we're now seeing the tariffs that were spoken of, 25% on Mexico, 25% on Canada, 10% on China. The assumption was that these were negotiating tactics to lead to better trade deals, and they might be, but they're far more serious this week than they were last week. Although we do have a stay for Canada and Mexico for 30 days. So we'll see how this plays out. We were talking in the car on the way up here. Not sure what the end goal is, if it's really about border protection or if it's about repatriating a lot of a business. We'll have to see. I don't know that that's completely clear at this point. I mentioned another potential headwind being immigration policy. So you can see the percent of foreign-born workers in the labor force has continued to grow over the last, almost 20 years now, to where it represents close to 20% of the labor force. That's, irrespective of whether they're here legally or illegally, they contribute a substantial portion. And that's important because the birth rate in the U.S. continues to decline. So more people are passing away than being born. And so we essentially have, amongst our population, excluding immigration, a declining labor force. So if you're not addressing that with immigration, it's a problem because you have fewer and fewer workers to fill the same or a growing number of jobs. You can see the split of authorized versus unauthorized here. Those more labor-intensive jobs have a higher percentage of unauthorized versus those that are more service-oriented. But if you deport, a substantial number of workers, that just puts pressure on the labor market and potentially creates wage inflation. Then last, just touching on the housing market here. So an interesting data point when you look at the number of Americans moving and the percentage of what's called the move rate percentage, how that's been declining, how that aligns very closely with the level of interest rates increasing and home affordability. So not only have you had increasing interest rates, you've also had increasing home prices, which is how this housing affordability number comes down. So, the real estate market is a substantial portion of the economy. When you have fewer people moving or purchasing, selling, it takes out, some of that contribution to overall GDP. And I'm sure you see it here locally within this community as well. So, this takes a while to fix. It's not just decreasing interest rates, because a lot of the people that aren't moving because they're at 2% or 3% fixed for 30 years. So 1 or 2% in interest rates isn't going to incentivize most of them to move. But it also takes an increase in the overall housing supply, which has been a challenge for a number of years. It's getting better, but again, that doesn't happen overnight. So I'll stop there, turn it over to Carol to cover performance, unless anyone has any questions from an economic standpoint. I can take those first. No? All right.
Any questions? We can wait until the end. Nathan.
That's fine.
Thank you
Yeah.
so much.
Good morning. Do you want me to talk in this? Is this okay?
Yes, please. We are being recorded,
Okay.
even though we're not being projected.
So I'm here to review fourth quarter and also end of 2024. So Nathan had talked about the market overview, and we did see that the bond market was down significantly. We ended off just the fourth quarter there down significantly, which did impact the portfolio for recreation centers, which is expected. We expected this. So just for the quarter, we started out about 29.5 million. And with the bond market being down for the quarter, that put a lot of pressure, ending value of 28.7 million. For the year, 2024, still a net investment return of almost $1 million on the portfolio. Asset allocation, just illustrating that we are still managing the portfolio according to the investment policy statement. 90% fixed income, and then 10% in the equities, which is divided between U.S. equities and some international equities. We also stay within the constraints within the portfolio to be diversified. There is a 20% limit, and we stay within those bounds as well. Returns for the quarter, just under 2.5%, consistently beating the benchmark, mostly attributable to our management within the fixed income space, within the bond space, within the portfolio. For the year, we did end up positive 3.3%. Bear in mind that just the fourth quarter there, the bond pressure was down 3%. So that's still a nice net return for the year on the portfolio, beating the benchmark of 2.77%. Calendar year returns still climbing out of 2022. We had a nice 2023, and as we told you, as I mentioned here just a moment ago, ended on a lower note, some pressure headwinds for the fourth quarter, but still positive for 2024. Just looking at some of the asset classes within the portfolio, total fixed income, 2.76 negative for the quarter. For the year, we're looking right here, the portfolio is 1.9%, almost 2% up for the year of 2024. We measure that against the U.S. Bond aggregate is the index that we use within the return measures to measure against the fixed income portion. Equities for the quarter, 2.2%, and for the year, you did achieve on the U.S. equity portion 22%. Now it is a smaller portion of the portfolio, but we did achieve that for the year. International exposure, down for the quarter 8%, and for the year we were up almost 5% on the international exposure. And all these numbers combined together will get back to the, for the quarter down 2.5%, but for the year up 3.3% within the portfolio. We do look at all the individual, they're all passive investments within the portfolio, and we review those every quarter and just make sure that they're tracking. I do want to get, I'm just going to pass through all these fact sheets for each individual security. And I want to get down to just one more page to point out some of our activities within the portfolio. Still maintaining, one of the objectives here is to have a portfolio with low fees, and we're maintaining the investment expense ratio at 0.05%, which is very, very low exposure within the individual investments. Duration statistic for those in the finance sector, we are taking active measures right now to go higher duration, And that's why we'll see some volatility within the portfolio in the bond sector in the short run. The SEC yield actually climbed. If you follow the yield curve, we saw the Federal Reserve target lower rates at the shorter end, but we've also seen the yield curve steepening somewhat. So those securities on the longer end, you have exposure across the yield curve. So we are benefiting from some of the securities on the longer end achieving a higher yield now. Any questions? For any of us?
First of all, thank you both for a great overview, for continuing to do a great job for us. A couple of things to just point out before I turn it over to the committee. When we look at things like overall return, we're looking at, from a policy perspective, are we adhering to policy with our performance, with our investment managers? Have they done that? Are we still, is the equity, liquidity, all of those components of our policy, are we still maintaining that? So we look at all of that as a committee. But when I'm looking at how we're doing overall, sometimes, the most important thing to look at is the benchmark numbers. So Carol, you did a fine job of presenting all of this and briefly, but just wanted to point out that while we had a bit of an off quarter, so did everybody, frankly. And it's not a reflection of either equity or fixed income. We just look at our performance against benchmark. So I think I highlighted that page for myself. It's, page 22 in your overall deck, I believe, where you look at the performance against benchmark in the quarter, the overall year and years past. And I just wanted to call out, I don't know CapTrust personally. I'm just assessing them as a fellow director, and I look at the performance against benchmark. I just want us to see that in every one of those measurement years, our investments have beaten that benchmark. Thank you for that. So just wanted to call those sorts of things out. And again, it's while we wish we had a crystal ball, Nathan, for the economy and for all the pressures that you noted, I wanted to thank you for breaking it down in everyday English. This group can really follow all the technical nuance. I'm sure they're going to have a lot of questions. But for the rest of our community, it's always great to hear everything in plain language, how it affects all of us in our investments. So just a couple of thanks for that. And now I'll turn it over to the committee for questions. We'll start with Mickey.
I have to echo that, right? When we look at how you do, we're looking at how you do compared to what we've given you as benchmarks, right? And I think that you've done a very good job and starting in kind of a rough first year. Right? So,
thanks, Jim.
Yeah, I thirded, I guess. Yeah, I mean, the constraints that were put on you, you've matched the benchmark. Yeah, my soapbox.
not yet.
Thanks. No soapbox there,
Nope.
but no problem. John, any questions or comments?
I don't have any questions, but I sure appreciate it. Everything that's going on, to see it presented so clearly, and every time you hit a page and it's a topic, it's like, oh yeah, and you guys explain it very well, and I'm very appreciative. Thank you.
Thank you, Chris.
So again, I'll thank you. Because there's so much involved, obviously we are looking at performance to benchmark. So I'd like to question the benchmark as far as how standard is that? Is that something that each investment firm would develop based on different calculations or formulas?
On page 24.
Yeah, so we use a blended benchmark based on the asset allocation of the underlying portfolio. So another way to look at it is to say we take the fixed income and we benchmark that to a fixed income index. So we take the 90% that you hold, we benchmark that to the Barclays Aggregate Bond Index, which is the standard index for fixed income. We benchmark the US equities, you can see up here, to the Russell 3000, which is the total stock market index. The S&P 500 is what you hear about the most, but that's only the 500 largest companies. So we used the Russell 3000, which is the 3,000 largest companies, because we own both large and small cap. And then international, we benchmark that to the MSCI, so that stands for Morgan Stanley Capital Indexes, I believe, all country world ex-US. So we take the international, they have a all country world index period, which includes the US, so we back out the US and compare the international to international there. And then we blend those together in the ratios that are represented in the portfolio. So basically it's, you know, if you didn't hire us to pick the underlying funds and you just use indexes, what would that result look like? And all of our performance is shown net of fees as well. So we incorporate the cost of hiring us, the cost of the underlying investments we use, and then measure that to the benchmark.
And that's if we had a different firm, they would do something similar, but not exactly the same, right?
I mean, this is, I would say, industry standard. I can't promise you that every firm does it this way, but it's how they should do it.
Okay.
If you look at any kind of institutional pension plan, large, you know, foundation or endowment, this is how they benchmark.
Exactly.
Okay, thank you.
David?
I would echo and concur with what has been said. The only thing I would say in addition to that, this is great foundational material as we begin to look at our assessment of our policy that we have right now.
Exactly.
So thank you very much for providing this information. We'll use it thoroughly as we do that assessment.
Thank you.
I just think there's a lot of information here, but I think it's great. However, I think the next agenda item will bring some of these things to some more questions involved in the analysis of all of this. So
Isn't it great how that works out, right? That they're here on the day that we wanted to assess, so it worked out beautifully. And Ed?
Yeah, as I look at it from an engineering standpoint, you were given some objectives. You developed your plan, and now you're coming back to report us that you succeeded with the plan. So it's great.
Yeah.
That's right.
Thank-
And I'll just make one comment about the benchmark. It's important in portfolio management just to stay consistent, and that's what we do. And if you're wondering, you know, how are we beating it every quarter? Just to manage expectations, we may not beat it every quarter. Quarter is very short term. So there will be quarters we'll come in here and we won't beat it. It has been, you know, a little bit easier because the Fed has shown their cards and they're raising interest rates, so we could position the portfolio to take advantage of that. And that's exactly what you're seeing.
And to Carol, to your point, there have been many quarters when you've not, and just recently as well, and that's perfectly fine. It's not something that we should expect, but when you look at the longer term, we've managed with your assistance to beat those benchmarks pretty consistently. And again, if you look at it over time, we've beaten them like year after year. So thanks for that. And we also look at things, of course, like the expense ratios and so forth. So it's all very important and great stuff. And we appreciate your being so candid about that point, you know, pointing out that you're not always going to be perfect and you're not always going to beat that benchmark, but those are the things that we look at over time. So thanks again. So we've had our opportunity to comment as a committee. So turn it over now to our owner members and residents. If there are any comments or questions. So there are none. I made the face because we have some folks here who follow us very closely, and I'm glad that they don't. And I see no comments or questions online. So with that, I thank you, Nathan, Carol, and Ryan, as always. A great quarter, and we'll move on to our next agenda item. And we're fortunate that we're going to have our CapTrust advisors remain here with us. The next agenda item pertains to our investment policies overall, and that's FI4 and FI12. And as the committee knows and all of our residents know, we formed a working group a few months back to look at those and to really dive down and to analyze. Now, at our last meeting, Mickey gave a very great overview of the background and why it's important. Today, Mickey's going to lead us through what she and Rick Rufai have been leading. I also wanted to make sure that we all know that while these folks are the dedicated team members, we've had the opportunity to hear from a number of our owner members, which is great. And we've also had a few of our members of the committee, Budget and Finance Committee, who've contributed both in terms of attending some of the working group meetings, sending emails and thoughts. So again, my thanks go to the entire committee. So also wanted to thank CapTrust, who gave us the benefit of some of their expertise, but Mickey will go into detail. So Mickey, why don't you lead us through?
Okay. Hello.
You don't have to turn that.
So, so last time I was here, I gave a pretty lengthy discussion of the process that we're going through. And so what we're going to try to do today is distill that a little bit into the actual models that we produced, what those look like, feedback that we got from CapTrust in terms of they modeled the same models that we modeled. And because one of the things that we wanted to make sure is that we were really in the ballpark, right? That what we were coming up with made sense. Okay, so the first thing is our current policy. As we've discussed before, our current objectives are preservation of capital, liquidity, and rate of return in that order. Equity investments are limited to 10%, and 90% is invested in fixed income. So here are the questions that we've asked. We looked at it. We kind of looked at what it looked like over the 20-year period. And so what we've said is, does this policy help support our association's development? Are these the optimal objectives and restrictions? And are we properly evaluating this idea of liquidity within the short-term and long-term cash needs? This is a conservative policy, right? It's a conservative policy, and frankly, it is in line. It's in line with recommendations for most HOAs. However, this is not a small HOA that uses up all of its funds in a 5-year period. That's not what we have here. This is a very large HOA with a very large reserve and very robust annual funding. So what that means is that this investment fund is actually a long-term asset. It's not a short-term asset. And that's the thing that we really, that's the question that we really wanted to answer and to look at. How do you invest? How do you invest for optimal results and address both short-term and long-term liquidity needs? Okay, so our evaluation process. The first thing we did, and what we've done to date, is that we got together with our finance group and we got their 20-year projection of capital requirements out for 20 years, plus the projections of the inflows during that same period of time. So we looked at that and we developed 4 scenarios. The baseline scenario is it's how we invest today with the 10%. Within the strictures of our current policy, baseline is where we started. And then we developed several other scenarios to say, what would happen if we did these 3 things? What would it look like if we had other alternates, right? And then the third thing that we said is that we did that, we modeled it all out, and then we said, CapTrust, we'd like to give you those same scenarios. Please model those independently for us and tell us what you think. Tell us what you come up with. So those are the things that we've done. So today, what we're going to do is review those scenarios and the feedback we got from CapTrust with this committee, with this. And then what we're really asking for is we want feedback, right? So this is the working group. Rick and I, together with Christine, also advised us, as did our finance team. So now we're looking for input. This is what we've done, and now we want input. So the first thing we're going to look at is baseline and our alternate scenarios. So 20-year model based on projected capital expenditures and inflows. Our sources of funds are significant. We receive annually asset preservation fees, the annual allocation from the association, and investment income. Our scenarios that we used are first 10% equity, then we modeled out 20%, 25%, and 30% with the balance in fixed income. So the only difference in these models is the allocation to equity. Everything else stays the same. All of the underlying assumptions are all the same. And our investment returns, when we modeled it for the working group, is that we used historical returns over the last 20 years and not average. We use them year by year. We actually modeled the ups and the downs, which you'll see when you see some of the graphs. And we used 3.5% for cash equivalents, which is higher than the 20-year average. But in our 20-year average, we had an 8-year period where cash returns were 0. From 08 to 16, cash returns, and we'll get back to that, were 0. So we actually said, we're gonna use 3.5%. We think that's kind of a reasonable assumption going forward. Then over the first 10 years, we looked at the annual funding over this first 10 years, looking at what we're gonna spend and what comes in. Annual funding covers 91% of what we're gonna spend. So what that means is that, and that's before investment income. So most of what goes out is covered by asset preservation fees, annual allocation. Over the 20-year projection, those inflows more than cover. So that last point is key in our evaluation. What it means is that most or all of the funding for annual capital spending comes from annual inflows. It means that we have a longer investment horizon in the reserve fund, and the need for significant amounts of additional liquidity are limited. So here's what you see, our 20-year capital outflows. The anticipated spend, this is everything that was included in the model. 85% of what's included in the model is from the reserve study, projected out over every single year over this 20-year period. We also put in 15%, and this is what our team puts in. There's 15% for additional capital. What that is new capital every year of about $1.4 million. That's what's included. That's about 15% of the spend. What we said is the cash needs, we told you, were higher in this first 10 years. If you look at the green part of the second pie chart, our cash needs are $96.6 million over the first 10 years. 80 million, 81, closer to 81 million in the second 10 years. That first 10 years is higher because we complete all of the golf course projects in that 10-year period. And after that, you don't have the gigantic projects that we have in this first 10 years. But you can see that's very significant, right? Very significant. But here is what's amazing, in my opinion. The deficit, even with the 10% equity strategy, so we cover 94.5% of our outflow with the inflows that are coming in. So all we had to come up with is $5.5 million in that first 10-year period. So with a $30 million fund, right? So basically, if you look at a $30 million fund, in any year, what you are looking at is plus or minus about $5 million that's going to be used. Now, there are years where it's more, and there's years where it's less. But we have the ability, to manage that over a 5 to 10 year period that allows you to, manage your cash, and you have a significant piece of this portfolio is available for longer term investment. Here are the assumptions that we used on a year-by-year basis, and this actually came from the presentation that CapTrust did for us that shows how it's modeled out. And you can see that in the first 10 years, you've got about every other year, you've got a pretty significant, outflow. These, again, in total, over that years 1 through 10, it's $16 million. However, that $16 million, that's before investment income. Before investment income. So, and then you can see from 2036 to 45, the next 10 years, every single year is positive. So here's a summary of basically our findings with these scenarios. 10%, 20%, 25, and 30. CapTrust expected return our working group expected return, the historical gross index return, which is what we just talked about, that allocation of the indexes by the amount of your allocation. That's historically, that's what the return would have been, and then the historical standard deviation. So what you'll see is that CapTrust, for the first two, 10 and 20%, were had a little bit better return than we showed. And part of that is because what we are showing here is what's called, it's the 50th percentile of expected results. So if you look at a bell curve, right? So you look at a bell curve with these two ends are less expected. This is negative, this is positive. This is what you expect. Almost your results accumulate in the middle in the bell curve. That's what that is. What we had is we actually modeled out 20 years of actual, right? What happened in the last 20 years with all of its this, that, and the other, right? We did that. So we actually showed a little bit less, but not materially. And then what's really interesting is you get to 25 and 30% independently, we came up with the same numbers. And then if you look at the standard deviation, the difference in volatility between 10 and 30%, it's not that great. So now go down. If you look, so here's what's really interesting in my humble opinion. So 1 in 40-year return, so that means in 100 years, 2.5% of the time, we would have a return of somewhere between -3 and -5. 1 in 20 years, so 5%, -2% to -2.1%, virtually the same numbers. Annual returns above 0 in all of these scenarios are above 82%. And the maximum historical loss runs from 16.5, basically, to 17.7. That's not much variability. So here's what it tells you, is going from 10 to 30% does not increase your risk significantly if you are able to manage your investments over the long term without constantly changing your policy, and that's key. So months to full recovery, I think this is very interesting. It actually goes down as your equity goes up, and the reason for that is that equity tends to recover faster than bonds. So after a big year, and this was demonstrated to us in 22. So in 22, we have 18% loss in equity, 13% loss in bonds. Over the next 2 years, equities recovered 25% in 23 and 22 or 23% in 24. Bonds also recovered, but not to the same extent. Okay, so here is the CapTrust model. And again, as I said, so what you can see in these first 10 years, those up and down periods, this little bit, that's not returns. That is how much money we're taking because we are spending our big high capital years. You can actually see that the scenarios stay very close. Our opportunity for growth is not great in this first 10 years because of our high spend. The opportunity for growth comes when you have the last 10 years when you have you actually are accumulating some funds. And what you can see here is that all of these scenarios end up kind of the same after 10 years and then grow and you're at 64 to 71 million out 20 years. And this is the estimated projected reserve fund balance under CapTrust. Okay, the working group, we're a little bit wider, and mainly because we're actually modeling out much wider variations, right? It's not an average. It's not a 50th percentile. It comes to an average, but we've actually modeled it out saying there's going to be good years and bad years, and you can see this. So we end at the end with a wider variation from 58 million to 73 million, which is about a $15 million swing between 10% and 30%. But what this shows you, here's what this shows you. whether you're looking at it from a average perspective or you weather the storm, if you weather the storm, you end up in the same place. So that's what this kind of shows you. So where we end up, so here's the projected reserve fund versus the fully funded balance. And what the fully funded balance is, that is the amount at any point in time that it would take to replace what we have in our assets. And our policy says that we need to be at least at 40%. We are at about 40%, and what you can see is, yeah, we're at about 40% here, and that stays at around that 40% during this first 10-year period. Go back to the next one. Thanks. But what happens, so here's what happens, and you can also see that in this period of time where we're doing all of these capital projects, so what happens is you put the new capital project in, and that grows over time. Once you are through this period of time where we are replacing big pieces of capital over the 10-year period, our fully funded balance begins to grow. And so we are growing with it, and we are getting better than the 40%. So now we'll look at that. So we end up at somewhere between 67 and 74% by the end, depending on what our investment policy is. So we are staying within or above our projected, our required 40% amount of the fully funded balance. Okay, so here are considerations for change. And having done this, Rick Rufai and I, together with the others who were advising us, is we believe that the working group believes that the current investment strategy is unnecessarily restrictive due to the big component of the fund that is long-term in nature. As we said, and this is just really critical, most associations do not have this great benefit of having such significant annual funding, right? They have to save and save and save and save and save, and then they spend it, and then they save and save and save and save again. We actually have this, our annual funding averages about $8 million a year, over just under the $8 million for the first 10 years and closer to $9 million over the whole 20-year period. So that's the inflow, not counting investments, not counting the return from investments. So very significant inflows. When you look at the significant inflows, that reduces your need for liquidity on an every single day basis. And when you look at that, higher equity exposure is appropriate for longer term assets. And here's the deal. Our baseline scenario, it keeps up with inflation, but it's just barely. And the first 10 years, it hovers around the 40%, but it will at times even dip down a little bit. At this point, there's not a lot that we're going to be able to do with that piece of it. But if we want to grow, we're going to need to consider equity in amounts greater than 10%. We are positioned to meet our scheduled repairs and maintenance and replacements, but there isn't a lot of cushion if we have any unplanned, anything that happens that's unplanned, or even more importantly, to put some money into strategic investments. As we go through the planning for our master plan, for long-term planning for the association, when we look at staying current for not just our current association members, but to attract our future members, that becomes more and more important. And I have to tell you, there is a risk, a real risk, to staying with the current investment strategy. Has always been this, there is this belief bonds are less volatile. right? Bonds are less volatile. But we saw a year in 22 where the volatility of bonds came back to hurt us a bit. It was unusual. But we also had a period of time, as I said, from 08 to 16, where your investment returns on short-term treasuries was 0%. That doesn't keep up with inflation. So there is a risk when you have a fixed income, nearly totally fixed income portfolio. There is a risk that that will not keep up with inflation, and particularly when you look at the big portfolio of assets that we have, and it grows every year, and it inflates every year, because what we're looking at is the cost to replace is inflated by inflation every year when we do our modeling. So we recommend, Rick and I, as the working group, we recommend a change to the investment strategy. The equity range right now is not a range. The equity is 10%. 10%, any number, say it's 10, 20, 30, any one number is a bit hard to manage too, because what that means is that if you have any fluctuation, that percentage changes. And so our recommendation is that there be a range of, there is a target, that we come up with a target, and we provide a range that allows that to slip below and above so that it doesn't have to constantly be rebalanced, that it is, that we're still working towards a target, but we're giving a range to allow for some flexibility. And it also leverages the expertise of our investment advisors. It gives them a little bit more leeway. Preservation of capital, we think, should have a component that assesses short and long-term cash needs. Right now, it just says preservation of capital that's our first priority. Well, here's the deal, is that preservation of capital could mean you stuff it in your mattress and you leave it there. That preserves your capital, but it doesn't preserve the spending power of your investment. So the investment of assets should match the timing of cash needs. If we need it in 10 years, and this is net, 10 years, what you do is you say, I'm going to spend X over the next 5 years, and I'm going to bring in X over the next 5 years. I need $5.5 million. That should be in low risk. It should be in no risk assets, right? That's in cash equivalents, treasuries, things like that. 5 to 10 years, we can have more risk. That's a bonds, other fixed income strategy. So you can have a little bit more risk. But over 10 years, equity is a very appropriate risk strategy. Now, we've looked at 10, 20, 25, 30. 30% doesn't cover your over 10 years. That is still that's still conservative, right? That is still a conservative allocation because we are a big HOA. We understand that people can be nervous about the market. So 30%, that is still, that over 10 years, that's more than 30, that's closer to 50% of this portfolio, but that's not what we're recommending. And finally, and this is critically important, our policy needs to address that in order to have the best investment results, you have to stay the course. If we say X, then you should stay there. Bouncing around every few years in response to vagaries of the market, what that results in is suboptimal results, because here's what happens. You have, say for example, in equities go down, people panic and they sell, okay? They sell at the lowest part of the market. They don't get back in, and in 2 years, you had what happened in 22, 23, 24. You missed your opportunity to participate in the upswing in the market. So we would highly recommend that the investment policy be set and that at a level that we can stick with it. So we're going to ask for, I have one closing slide, but what we're looking for is from the Budget and Finance Committee is your feedback, your concerns, your thoughts, so that we can assess what we think is appropriate risk and start developing our proposal. So here in closing, one more.
Trying.
All right, so here we go. So these are, and I said this last time, so these are two of our association's stated ideals, that we should adopt sustainable economic policies that ensure both short-term and long-term financial health, right? Supporting our needs, enhancing lifestyle of current and future members, and that our amenities, operations, and infrastructure will be maintained to modern and attractive standards, and that we will remain efficient, attractive, and competitive. We think that changing our investment strategy will help us to position our investment fund to help us meet these ideals.
Thank you, Mickey.
Okay.
Great overview. Don't go anywhere. I'm
Okay.
sure there are going to be questions.
Okay.
A couple of things to point out. Mickey addressed this, but if you, I'll repeat or reemphasize. At this point in the modeling, our operations team has done a fantastic job. You've heard presentations from Cliff and the team about how they manage our reserve fund through the reserve study, right? So they're projecting out asset replacements, repairs, and also projecting out to the best of their information and knowledge based on feedback from board and their own input, the new projects that could occur. But there is, we don't have a lot built in beyond what's currently known. And again, this is, we don't have a crystal ball. But remember, we've now started, our general manager has addressed this already, we've started the process of strategic planning that will lead to master planning. The strategic planning over time will identify priorities for our association that are not built into our current reserve study. So the numbers that the working group, what Mickey just walked us through, look very, very healthy and promising, but remember as well that they do not include anything beyond repair replacement and the much of our capital outlay in those first few years around our maintaining and improving our irrigation on our golf courses. Those are the big things. So as we come up with new projects, we will have to address how to pay for those. So just bear that in mind.
Yeah.
The other thing, and again, Mickey, this is not necessarily just a question for you. You started to attach it, and we did have a question that came in late on our returns. Perhaps you could address what occurs in this kind of an investment policy if we did stuff our money in a mattress, using your terminology. If we used just CD laddering or T-bill laddering, that would be, I believe that's even more constraining than the current model,
Correct.
is it?
And we did not model that, right? So we did not model zero equity, right? We started with the 10%, we did not model. But what you can, and maybe I should have, then I could answer this precisely.
No, just a okay.
But that does not keep pace with our requirements. So if you look, I think we're using 4% and 2.5% as our inflation factors. If it is longer term, we're using longer term meaning
Assets with a useful life larger than 10 years.
10 years.
As a 2.5% inflation factor. Assets under 10 years and under have a 4% inflation factor.
And again, so here's what I can tell you over the last 10 years, risk-free treasuries averaged 1.6%. Now that's low, right? That's low, which is why we ended up not using that for our future numbers. But there was an 8-year period, as I said, where returns were zero. And we could have that again. And from an investment perspective, you have the opposite issue when then from a low rate environment, when rates go up, we saw that in 22, where then you have principal risk, if you've got principal risk, because as rates go up, the value of your bonds go down. So anyway, that would be, if you stuff it in a mattress, you will erode every year the value, the purchasing power of your investment portfolio.
Thank you. And again, we'll defer the rest of the questions for those who are listening online. They have questions about the investment returns more historically, and we'll get to those by the end of the meeting. But thank you, Mickey, for addressing it here for the future.
And I'm just going to sit and we'll answer from
Yes.
mine.
Thank you again. So as we consider and ask questions, I just want to make sure that the committee's aware of the outgoing process. And again, my tremendous thanks to Mickey and Rick for the hours and hours and hundreds of hours that they've spent on this, together with our finance team and with the input of our expert advisors from CapTrust. They also looked at this, and we have some assurance, therefore, that it's not just a group of residents that are coming up with this model, but also with a lot of input and expertise from a broad variety. So thanks for that. If you are listening online, now's the time to start typing in your questions, because there's always a delay. The other thing I want to remind now our Budget and Finance Committee, our goal in the end is to come up with recommendations. I've asked, as the advisor, I've asked Mickey and Rick to be prepared to make the same presentation or a similar presentation to our governing board for their feedback. So this is your opportunity to provide some color, if you will, some input, and at the end of our discussion, I will ask us to ensure that we are comfortable making this type of update to the governing board. So just so you're aware, that's the outcome for today, not a final recommendation on investment strategy, but rather making sure that we're all comfortable with this type of content going to the governing board. So that being said, again, my huge thanks. We're going to skip Mickey and Rick's input and commentary and start with you, Ed. If you have any questions, we can come back to you too, because it's always a drag to be the first person. But so Ed, why don't you kick us off if you have any comments or questions?
Yeah, on what do we use for the APF projections? The 13 years I've been here, there's been a number of years where we haven't taken any APF increases. And do we have a process that we can communicate? Because that's the major input, to pay the bills.
Yeah, that'll be a good one for Cliff, Mickey.
Yeah.
Yeah, so in the modeling, we model out 1,100 APF transactions per year, and we increase that by a 3% factor in terms of the rate, APF rate. So 1,100 per year at a 3% inflation factor.
Do you feel comfortable with that when you do your budgeting to use that as a
Yes.
input for that? Okay. It's out of the scope of what you did, but as I remember a couple years ago when we had a lot of discussions about investments, do we have something that we could encourage the board to do as far as having that roadmap compared to what we're doing, so that we don't get so caught in 1 year is a, big, uproar as far as what's going on, so that years from now, when everybody's gone, it shows up in our yearly forecast, how we are doing compared to the modeling. So try to avoid what I thought was,
An overreaction, yeah. So we talked about that in the working group, and it really is going to be kind of a continuing education program, because our board does turn over by 33% every year, sometimes more. So every 3 years we have a new board. And so it's a combination of, here's the strategy, here's why we have the strategy, here's the projections on that strategy.
and here's the performance to those projections. So that's definitely going to have to be part of the program if we however, including the current policy, we should adopt that right away.
Right, that's,
Yeah.
and that's one of the recommendations that the working group has come up with. Don't know how or what that's going to entail, but I believe one of the recommendations is to come up with some way to inject into the policy something addressing how quickly or the impacts of making that kind of change to strategy. Remember, one of the things that the working group just went through is that there were 3 buckets, right? That the first 5, that any cash that's projected for needs in the first 5 years, it's, no risk. And then you have moderate risk and the higher relative risk, right? Those are things that we can afford to put a little bit more at risk once we go 5 to 10 and 10 to 20.
Because I know for the yearly presentation, the GM has to take like 4 previous years or 10 previous years for a given, replacement, or if we can have that in some general terms for our policy to.
You mean repair and replace?
Yeah,
projections?
there's different requirements of how far you go out with your full funding balance, it's X amount. And again, you can't just look at 1 year, so if we have that report card documented, we'll never lose track of what we're talking about with the variability and keeping up with inflation. So otherwise, that's great. I really thought it was fantastic. Everything.
Great, thank you, Ed. Those are some really good ideas and things for the team to consider. David, any comments or thoughts?
Sure. First of all, thank you to all those that have been involved with this. This presentation is one you would expect from either a financial wealth manager or a business school project. If you're in business school, this would be the type of quality
Classic.
of performance. Classic, exactly right. So congratulations to both of you and everybody else involved. I appreciate also CapTrust being involved because that gives us a little outside of our own circle of individuals we have that have done a great job, a little bit of expanded assessment as well as trust in what we are coming forward with. I think the question I have, and it kind of tacks onto what you said, Christine, and that is, we realize that this model is put together with current plans of expenditures for improvements that we have and for the next 10 years, primarily around the golf courses and just keeping things up of capital improvements. And we are not right now undergoing, from what I understand, an assessment of our strategic plan and master plan. And so my question is on timing of this policy. Would you see anything from your conversations, either from that committee or anybody involved in that the process that we're doing now, looking at the strategic plan, that would potentially alter this recommendations of where we do the investments? Or can we make the policy written so that there's a little bit of latitude and give so that if those type of things would occur?
So we looked very much at this in terms of how it would dovetail with long-term planning. Mm-hmm. And that because if you don't do anything, as we said, there's this will not cover every strategic planning need, right? Mm-hmm. It most likely will not. However, what it does is gives you a cushion for investment needs that are as a result of strategic or master planning. It gives you some room, right? It gives you some room. And so we thought about that very much is, what are we going to need in the future, and how can we position our investment policy to support not just repairs and replacement, but strategic needs. So I would not change this. I think this policy works from both simply repairs and replacements. It just gives you a much better return. And it works if you have strategic needs in the future.
When you say the policy recommendation, your statement, that comment is one in which you are making an assessment that the new policy would not be as dogmatic in that
it will still, so it's not that it's not dogmatic, right? Okay. That is not, so what it says right now is 10%, 90%, right? That's what we're saying at this point in time. What we are saying is that, with an asset that has such a long-term horizon, 10% equity is simply inadequate. That it does not, that our current policy does not match up the timing of our needs with appropriate investments. That's what we're really saying, all right? So, and you can see it if, when we even look at it again, what happens is if you rely so much on risk-free does not allow you to grow. And so this doesn't match up it just doesn't match up with the buckets. And here's the thing, I am a data person. I do not say, I think 60/40 is great because I've heard that repeated time and time again. That's not what I look at. I look at what is the investment horizon. The investment horizon is short-term, medium-term, long-term, and you match up your investments to meet those. And so, say we had a less robust investment fund, it might all be utilized in 10 years. You need that. Well, here's the deal, then you should have no equity component. That's not the case. That's not what we have here. So I, in putting this together, looked at those three buckets. When we modeled, Rick and I looking at it, that's really the case, is that you are taking your time periods and making sure that your investments are appropriate for the buckets that they're in.
And I think, David, think of this, we're recommending right now as a committee, right? We're considering the work of the working group. We're creating or crafting an investment strategy proposal. Not so much the underlying policy is going to be very difficult to adjust to meet that. But first, this team has come up with a strategy proposal for us to consider making to the governing board. Then they can start crafting the underlying policy, and that will be very challenging. The policy that we currently have is very, very detailed, very well written from a detail perspective. So please, there's no implication that this is a poor policy, but rather looking at the overall strategy first and our ability to pay for anything that we want to do in the future. So I think some of the recommendations, if you can look at these and the recommendations at the very end around, there were 5, I believe, overall bullets, including not just the blend of equity versus fixed income, but rather putting if there is any risk, more risk on the things on the money or the funds that we do not believe we're going to need right away. Those sorts of things, and a range of a target with a range of acceptability around a target and so forth. These are some of the central.
And by putting in a range, it gives us some flexibility of how to move your assets around. And it gives CapTrust more ability to manage the portfolio the way most investment firms manage a portfolio. So it really, and you can change that target every year. The range would be one thing, but the target could change every year depending on what capital needs you have for that year.
Potentially, it's something to consider. And remember too, that we have our finance team that's watching this every single day, working hand in glove with our investment advisors, CapTrust, on all of this. So this is more, as you well know, the overall policy and the strategy for the governing board to adopt and consider. I hope that helped.
I think so, and I think what you've answered to me, and I think what's important for those listening or maybe out of our members, is the fact that we can plan so well, but there are always those unexpected or potentially new programs or whatever that we want to do, and we have an ability to adjust accordingly with where we're recommending it forward. But what we're trying to do is set that policy or set the process so that we have a firm foundational basis by which we move forward and then make those minor adjustments as necessary. And that's just all part of daily. We do the same thing in our own personal budgets, so
right,
it's the same thing. So thank you.
Thanks for the input. Chris, any questions or input?
Yeah, first, great presentation. I think it was very good, easy to follow. Made some very, very good points. I do have a question that I haven't heard a concrete answer yet for, is the history of our investment blend. 90-10, I don't think is a 40-year-old policy.
It's not.
And I'd like to, part of this is to express that this may not be an earth-shattering big change. This could be going back to what we probably should have done, in the past.
Actually, Chris, I'd rather not advise on what we should have done in the past.
Well, right.
But rather,
Understood.
but we can assure you, and the team can give you the specifics of when this changed. But it was in response to some pretty serious market pressures, in 2021, I believe, were the most recent. But over the course of history, the associations had a variety of investment blend recommendations and strategies, some more risky than others, right? So this 90-10 blend is around 2021, as I recall. Is that right?
Yes, that's correct. We were 40-60, 40 fixed.
Okay.
I'm sorry, 60 fixed, 40 equity.
Until that time.
Okay. Yeah, I think that's an important point, that, this is a reevaluation, right, of taking a look at that. I did I think the idea of timing, when we need the cash just makes sense. I know I do that with my personal, finances. I'll bet you most people do. And it just makes sense for us to do that. Naturally, any change comes with a possibility of Monday morning quarterbacks, with the wrong year, overvaluating, unrealized losses. So, but otherwise, I thought it was a great presentation. Needs very little, if any, modifications, because I think it really made a good point. Thank you.
Great. And thanks for for all of the Budget and Finance Committee members, thanks for the input throughout, not just today. John, any questions or comments on this policy or strategy?
I have a lot of questions, but I think most of them have been answered. Very impressive. Have we presented this to the governing board in the past at this level?
Well, not this Budget and Finance Committee, no. The last time that a change like this was addressed was, again, a few years back, so.
Okay, it's just very good, and I'm glad that we're going forward with this presentation. I just want to make sure I heard a couple things right. The 15% for new capital, that's built into this. So we actually do have a little bit in there. I thought I heard the statement of, well, we cover ourselves going forward, but we cover ourselves plus 15%. Is that
We do.
Is that
We do.
accurate?
That is true.
So that's great.
Yes, 1.4 million per year is modeled in the
Excellent.
cash outflows for
Okay.
new and enhancements.
Great. And then when I looked at your standard deviation, that page there, I thought I was hearing you say it actually shows the risk from 10% to 30% is actually minimal. Is that the right conclusion?
It's
can't be.
not, so here is what, when you look at it, it's not zero,
Yeah.
right? It's not zero. But if you look at this, and you can see it right here, if you look at this, those are small changes.
Right.
I expected those to be wider. Okay, so,
Right.
and here's the beauty of having CapTrust do this for us, right? So we're junior modelers, right? We put together and, used historical information. What these guys do, it's a Monte Carlo simulation, which means they basically do 1,000. They do the model 1,000 times randomly, and then show you where those with high years and low years, right? And then what we get is what's the top of the bell curve, right? That is what we're showing you here. And then they're calculating what the standard deviation is. Those are the difference of 5.7%, on 10%, to 6.8 by tripling your equity exposure.
Right.
That's little. That's not very big. And more importantly, so you even look at the maximum historical loss, right? And it goes from 16.5 to 17.7. And then months to full recovery goes down. That is, and it's also in a piecier portfolio that you don't need to touch.
Yeah, I just think that's powerful
It is powerful.
data, and even more that, I don't know if we get to ask them, but I think what I hear you saying is they're agreeing with those numbers and that conclusion. Is that right? Yeah, I see a little bit of it.
Could you step to a microphone? I'm so sorry, for our recording.
And there's context to the maximum historical loss, which is it was 2022
Yep.
when the stock market was down 18%. The bond market was down 13%. That's the worst bond market in the history of the world. So the odds of that happening again, fairly low. And Mickey's right. Like when you add more equity, you give the portfolio the ability to recover faster because equities can outperform fixed income. So we like to say there's two ways to manage risk. One is diversification, and it could be argued that right now you're not very well diversified.
Right.
You have concentrated exposure to fixed income, which 95% of history has been fine. It's the safest asset, except for that 5%, right? The other way you manage risk is time, and I think that's the argument you're making, which is you have time on your side that if you do have a bad market, you can wait it out and recover because you don't need all that money in any given year.
Yeah, thank you very much, Nathan. So we're looking at things like Mickey had stressed in the course of her presentation that she and Rick had taken all of this detail, and all that detail that came back from CapTrust is included as an attachment here, so that we, our owner members, the governing board, and historically speaking, we're going to retain this. All of that, the detail is there if you are interested and want to see all of the different scenarios that they crafted. And remember that we're looking at some of the standard deviation as an expression of relative volatility and so forth. So again, we love the numbers generally. This is the numbers group, right? Not saying that other committees are not as focused, but we love our numbers. And I think it was really important to draw these conclusions. And I also want to respect and repeat, when Chris was looking backward, remember, I think Nathan's comments about the timing of some of the changes that the governing boards of the past adopted were in literally unprecedented times. So it's really not, I don't think it's a great idea to ever question what happened in the past. Nonetheless, just know that the responses were made to some unprecedented social and economic pressures. So we really don't want to look backward on some of that and second guess it. It's that Monday morning quarterback type of thing. So we're not going to do that, but rather just know we've had a more, if you will, relatively risky portfolio mix in the past. That's the important thing I think you were asking. So, John, anything else?
Nope, I'm good.
Yeah, this is a lot of detail here. So last but never least, Mr. Scott, any insights?
So with the 90-10, that portfolio would do well in a low rate environment.
So it depends how you define well. In a
Yes, no, I understand.
In a low rate
We're
environment,
not going to get
you
double
will earn
digit
a
out of
low
that
return
ever.
with a 90% fixed income portfolio.
But yeah, you're right. The word well is not the right word, but it performs to expectations in a lower interest rate environment.
Yeah, I think the risk that this group is addressing is the fact that a 90% fixed income portfolio will deliver bond returns, which may not be sufficient to manage the outflows and keep pace with
I
inflation.
totally understand that. What I'm trying to circle around to is what Mickey was pointing out, is that there was an anomaly where we had a low rate environment between 08 to 16.
Okay, so low rate environment, that's a no rate environment. I think that nobody does well in those 8 years, right?
So what I'm pointing out is that was during the rates were that low to stimulate to get us out of the great financial crisis.
Correct.
The housing crash. So will we ever go back to that? Heaven only knows, literally.
Correct.
And so, and that's why I saw the 90-10. I understand. I run the investment club, and so I understand that the argument of laddering CDs and treasuries. I understand that logic as well. But people need to understand that this is basically set to tread water. This is not going to give us any opportunity to take advantage of time and put us in a positive situation for any growth or whatever our journey with the strategic and master plan takes us. And so the effort that you guys have put in is really breaking groundwork to take us into tomorrow. And so I just hope everybody understands that. I appreciate everything you've done. You made it crystal clear, and I hope everybody else can see the bigger picture as well. Thank you.
One of the things that, there's a lot of details that we put together to get where we are today. My thought is that this is a tool that can be used into the future to see where we are from a modeling standpoint. And this could be used by the finance committee every year to see where we are.
And
to
adjust
see,
it.
our forecasts, are they correct? Are we doing the right thing? And so this could be used as a basis for, if you want to do some strategic planning and putting capital expenses, further down the road, big ones, what would be the impact on our model?
That's a great point, Rick.
So,
And this is potentially the model that you guys have built. This is a tool that could be used
right.
going forward.
I just hate to, how do you say this? There's an awful lot of work and a lot of detail that was put into this, and to throw it away is not the right thing to do. So you should build on this and move forward.
Well, I don't think anyone's proposing
Yeah,
throwing
yeah.
anything away,
Well,
but
I mean,
nonetheless.
Yeah. And to your point, Rick, and the point that was made previously, if we also look at it from a historical perspective, and you can see what your results are, because it's interesting when you look and you can see, okay, this year we went down. Okay, yes, but it tends to recover over X period of time, and it tends to more than recover. And you can model it out, right? That's what we do, is that you can model it out. You can say, if I had stayed in bonds this entire period of time, I didn't have this deep dip, but guess what? 2 years later, the line is above the bonds, right? And so I think we can use it also to demonstrate the historical perspective, which is there is a benefit to having a coherent investment strategy that you stick with. Okay?
Excellent. Let's take a picture of that. Any other, and again, thank you. Jim, any other commentary that you wanted?
That's it. Thank you.
So before we start considering what we're going to do next, I turn it over to any of our owner members and in attendance or online. Do you have any comments or questions for the working group? And the same thing for those of us who are listening and watching online. Thank you to the residents who have already posted. Please give us your name and your rec card number as you make your comments.
Hi, Nick Turner, 131829. As an economist by education, I just love the idea of playing with models and putting different assumptions in there and seeing what happens. And you can gain and have gained valuable insights as a result. I do think one of the key insights that I don't know, I won't say stumbled upon because that's not
Because
what happened.
I'm also an economist.
Yeah, one of the key insights you've come across actually is the most of the spending by a huge amount is actually covered by the annual receipts, and therefore there is no need for short-term cash coming out of the fund on a regular basis. I like the idea of flexibility in management, whatever the percentage is, because that's going to reduce the amount of active management and continual rebalancing that's needed that CapTrust are going to have to do for the portfolio. And I would also say I've got new data today, and I'm probably going to change my mind on what the assumptions are on the balancing of that portfolio on the 60/10. So I look forward to the debate that we're going to have as a community here about whether it's we change it to 20%, 30%, 35%, 40%, whatever it is. I think that's going to be an interesting debate, and we'll see what the risk tolerance might be in the community for that. Thank you.
Thank you, Nick, for the comments. It is true. There'll be debates, discussions, and we hope a decision on some of these points, even without. I think some of the embedded recommendations of this working group and potentially the Budget and Finance Committee as well would even go beyond. They could be implemented without a change in the equity balance as well, right? Ranges and so forth. So thanks for that comment. I don't see any other questions that have come in online from our residents that are watching online. There were questions on our previous topic. I again just want to thank the folks who have put in so much time and effort. And I'm going to look to real quick, I don't even know if we need a voice vote on this because we're not making a recommendation. I would just want to ensure that we have consensus that you're comfortable moving forward as a committee in the voice of Mickey and Rick to come to the governing board at their next, at our next workshop, which is on February 14th, provide the same sort of overview for their feedback as well. So does anyone have any concerns with moving forward at this time? I don't see any. Thank you for that. And no further comments from our residents. So with that, Mickey, we were already planning on doing it, but we wanted to make sure that the committee was comfortable. We will do the same sort of presentation to the governing board and to the community at large at the upcoming workshop. Again, no recommendations, so this is more for guidance, for feedback and education, yeah? So thanks again to everyone who participated, and again, our sincere thanks to our investment advisors from CapTrust for giving us all that great information, which is all now online for us. Before you do leave, normally what we do is proceed forward through every agenda item. We did have a question that came up on your presentation. So while we have you here, and I know you've stayed a lot longer on our request, and we appreciate it. So the questions, I will read them verbatim, and if you can address them now, great. If not, we can get back later. But the resident is David Bennett, rec card number 137887. How does the return, and again, right now I am addressing specifically the agenda item 3.01. So I've returned to that. 137887, David Bennett, how does the return compare to laddered T-bills and CDs? Using current rates, what would have happened between 2021 and 2024 had we invested in T-bills and CDs? And thank you, Nathan, for stepping into that.
I don't have the exact data. I think the challenge with 2021 was that, to Mickey's point, you had a long period of time with very low interest rates, and the yield curve at that time was 0 to 1.5%. So even if you're laddering, at best, you're getting 1.5% on what are probably 5 or 10-year treasuries, which creates a liquidity concern if you need that money. So yes, completely safe. Yes, if you hold to maturity and I put $100,000 in a 10-year T-bill earning 1.5%, I get all that money back. But if rates move up like they did in 2022, that position's down 15%. You don't want to sell it at that moment. And again, you're underperforming inflation over the long term. So there is, we like to say there's no return without risk, and there's lots of different risks you have to take and take into consideration. I can tell you that we manage billions of dollars for foundations, endowments, groups just like yours. Nobody's using laddered T-bills to manage their money. It's just not prudent.
Thank you for that advisory. And I appreciate it. I think that's that was the question on the previous, and it does sort of blend into this discussion of investment strategy. So thanks for that, Nathan. And
Any others?
thanks for the questions that were online. That addresses the questions. So once again, I think we've achieved what we needed to do in both agenda items 3.01, 3.02. Thank you so much, Nathan, Carol, and Ryan. And we're going to move on now to number 3.03. Chris, you can walk us through the revised FY10 procurement policy red line. And we have a hard copy, folks, of all the things that are on, so it's just really buried in here. I'm going to move forward to that. Go ahead.
I modified this from our last meeting based on a lot of input and a little bit of education we got that there's other policies involved for the general manager and the governing board in general policy L02. So what we need to do is eliminate them from here so we don't have a conflict or duplicity, and also move the requirement for the employees to the general manager, and then the only people left were committee members. Mm-hmm. So my recommendation is that we modify FI10 policy 6.2 to read: the general manager is required to create and communicate a gift from vendors policy to establish guidelines for employees regarding when and what type of gifts they can accept from vendors. To avoid actual or perceived conflict, the policy should prohibit cash or gift cards of any value and specify a dollar limit for the value of acceptable gifts. A violation of the gift from vendors policy can be grounds for immediate dismissal from employment. Okay. And then we also add 6.2 to read: to avoid actual or perceived conflict, committee members must avoid accepting gifts or other items of any value, including but not limited to meals, tickets or events, special favors, loans, discounts, free service tips, and gratuities. A violation of this policy provision is grounds for immediate dismissal from service as a committee member.
Thanks for the input on that, and thanks for reconsidering. One of the things that that we also discussed, Chris, was there's another policy that governs conflict of interest for the governing board. There's a little bit of there is a conflict, if you will, or duplication in section 6.1 and 6.3. So we can continue to go forward just from a committee standpoint. We can go forward by there's a strict prohibition and so forth. We could move 6.3 to a subsection of 6.1 so that it's clear that what committee member means. I believe you mean budget and finance, but it could be any committee, correct?
Correct.
So all our committees are extensions of the governing board. So my suggestion for the consideration, your consideration and that of the committee, is that we move what's currently in your 6.3 under as a subsection of 6.1 and add the language any governing board committee member. Would that make sense to you before we put that out to?
That makes.
I turn this over to the committee first. Any feedback from the committee on the red line and the adjusted red line that I just suggested?
So I think
Mickey?
it makes perfect sense to throw back for employees, right? For employees, let's have it be established by the general manager and in the employee handbook. I think that makes perfect sense.
Mm-hmm. Any other?
Yeah.
Jim?
I agree. I guess my 2 cents would be that I would put the whole schmick and caboodle violation thereof also within the general manager's policy. And just put the onus of the employee in the general manager's policy. I liked your suggestions for the committee members. And I guess I'm going to throw out the idea of adding a reference to the policy for the governing board director.
Good one. That would be policy L02, right? So
That
we can
way,
add that,
yeah,
right?
we got all three bases covered.
Chris, does that make sense?
That does. Jim, I have one question. The first thing you not the caboodle and whatever it was. But I think your first comment, I'm trying to remember exactly what, it had to do with the employees and the dismissal.
Yeah,
Can you
I would.
clarify that?
Yeah, I would just take out the violation aspect of the policy. I would just put all of it. The violation of it will be residing in the general manager's policy.
You know, the way I looked at that, I looked back to the famous what versus how, and I think as a committee, we expect them. I wanted to voice that that's what we expected to do. How they figure it out is up to them. That's the way I looked at it.
Stephen?
Thank you. So what I'd recommend is that last sentence, and prefer actually, is it would we read something along the lines of a violation of the gift from the vendor policy is subject to disciplinary action up to and including termination. That gets to the point of putting it back into our policies and the discretion of the general manager, but addresses in the policy so that people understand that there is something dealing with employees. But because to basically say can be grounds of termination, I mean, it really needs to be, there's a process for disciplinary action depending on what that is, and it could be dismissal, but up to and including termination. Yep.
You know, I had that there in my earlier draft.
And you took it out.
Well, that sounds like a very sound recommendation, and if it's in your, and it ties that together. And so just to summarize some of the recommendations that we've come up with here, there's the recommendation from our general manager on how to integrate into operational procedures. The recommendation of referring to policy L02 as described in and so forth, and adding in the reference to any committee members, right? So a small number of revisions.
Moving 6.3
up to
6.1.
1.1 or a subsection. Because these are not huge changes, but because we've made a number of changes to the red line, if you can take one more pass at that for us.
Okay.
And I do regret it, but I wanted the opportunity to have everybody else comment before you made any changes. But it's a very minor number of revisions, and then we'll review that one more time at our next meeting and make the recommendation to the governing board.
Okay, I'll do that. Thank you.
Any comments from our residents or from staff? None. Oh, I do see a few folks stepping up. We'll start with the residents first, if that's okay. And the same thing goes for those of you who are watching and listening online. Any questions, please type them into the comment box. Use as many comment boxes as you need.
Gary Bach, 135435.
Thank you.
Originally, we had the $25 limit in there. And I'm kind of wondering, you're the committee, you're representing the residents. And now we're giving it to operations to set that amount. And my concern is that some community members, depending on where it's set at, are going to say, that's too high, there's no control, you didn't represent the community by putting a limit on what that amount could be. So operations, and I know they're not going to do this, I'm sure, but they can make it $1,000. So there is no, unless I'm missing something, that would be my concern.
It is possible, Mr. Bach, that they could create such a procedure, but that change is something that the governing board would be aware of, and I would have a lot to say about it. But thank you for that comment. There is that opportunity, you know, from an optics perspective. Is that the, as Chris mentioned, is it the famous what versus how? This just says we're empowering the general manager to create that procedure, that policy, and make it an operational procedure. And we are no longer going to set the limit directly. So that is a good consideration for us to have. In my experience, an overall governance policy such as this doesn't set the specific dollar limit, but directs the team to actually create that limit for review. You're right, though. I do hear what you're saying, but it's something that we can take under advisement. Any input or feedback from, experiential from either from you, Cliff, or from Stephen on that in terms of the presence of the dollar value in a, I know you are more than, I'm not trying to put you on the spot. In your experience, other than rec centers of Sun City West, do we, the dollar value in the policy itself?
Yeah, I've actually seen the policy written with no dollar value before. So I've seen both ways, and you're right. It's going to be reflective of the general manager's limit. It's going to be reflective of what the board's appetite is for something like that. And I think that, I don't even anticipate us changing it from $25. So that's what's currently set at now. So.
Exactly.
Yep.
Thank you for the comment. Appreciate it. And thank you also for the comment on that. It's not, we'll have one more pass at this to make a recommendation as a committee. And of course, the governing board can either accept or deny. We have another?
That as a member of the Chartered Clubs Committee and a liaison for clubs, you go along to a member meeting or a committee meeting and there may be coffee and cookies. And when the Properties Committee is on its tour and it's visiting various club rooms, the club might have some muffins or something there for the Properties Committee. I was just wondering, how strict or what are the interpretations of this going to mean? Because that club may be trying to look good to the Properties Committee because they have a capital project coming up. I mean, is there any leeway there, or are members of committees simply not going to be able to have a free coffee or a free muffin if they're going about their job as a member of that committee?
Governing board directors, right? So, so a very good comment. If we look at, this would defer that, this would really defer that question to policy L02, I believe it is, the conflict of interest policy, which does specify a dollar value. And it would require all the directors and all committee members to be subject to the same dollar value. It's very subjective, and I think the same would be said for our staff. The idea, of course, is more from a vendor's perspective, right? It's that conflict of interest, but it's a valid point, Mr. Turner, and but it's one that we're going to have to defer to if there is any change to policy L02. What would that be? Right now, that dollar value is there in L02, and we're going to recommend, it appears, that the committees be subject to the same policies. Thanks for the comment. Anything else? So again, Chris, thank you so much for the work. We have one more. You had no idea what you were getting into with this, but it was excellent. It seems like a small change, some of these things, but they do have some pretty substantial implications. So thank you again for taking the time to do that for us. We're moving on now to section 3.04. We're once again, Carl Wilhelm will be walking us through the changes to the presentation that we saw 2 weeks ago at the 21st.
Just for a disclaimer, capital section, no cookies.
Nor have they ever been. So,
Good morning, everybody. We are in February committee meetings, and thank you for including this presentation in the first of the two BNF meetings for the month. This puts us in a better order going forward for recommendations moving forward. I'm going to keep it brief today, but you've had this packet. I'm going to pretty much just announce a few changes. There are only a few, and give you a review of the overall capital budget totals as they sit today. As you are aware, and it's on the screen, we have our three major components. We have new capital in our tan section. We have R&R replacement for the recreation division in blue. And then we have R&R in green for the golf and landscaping division. And then our final component is allowances. So if you will, I will just mention that there have been no changes since January in our new component, and that still totals $190,000 in proposed capital. Moving over to R&R, we've had one addition and two subtractions, and I will point those out very clearly right now, and then in my presentation I'll go over one in a little more detail. So I'll start with the two deletions from our proposed capital budget from last month. The softball outfield electronic scoreboard has been deleted from the FY25-26 proposed budget, and that is simply because with the governing board's approval of that sponsor-funded project through our softball club, I have already initiated that purchase order, and the project should most likely be installed prior to the end of April or early May. So, in fact, today the general manager will be signing off on the vendor's contract with me. So that is being deleted, so that $70,000 is not being proposed. And then after a little more discussion with facilities maintenance and our accounting team, Russ Boston has deferred the Palm Ridge pool circulation pumps to a future year. There is no need for those, and that's an additional savings of $14,135 from this proposed budget. And then moving on to the added item, we got notice for some of our safety equipment. So we are adding for the replacement of 42 AED devices at a cost of $68,000. And those are the three changes to the FY25-26 proposed budget. I'm going to move over to our slide presentation, and you'll see these numbers in total. Page 2, you will see the new capital is at $190,000. Repair and replacement for recreation division is at $2,052,377. Repair and replacement for golf and landscaping is at $2,714,776, and allowances remained at $520,000 for a total of $5,477,153. It was from this committee that questions of deferral. What do we do in the beginning of our proposed budget year in coming up with this list? And we look at our reserve study for all the assets. There are a handful of items each year that we recognize that don't need replacement just because their useful life in the reserve tool says that it's met its useful life. This carpet would be an example of that. So for the 25-26 review of our capital, we had deferred $1,137,123 to future years. So that's just a bit of information. Moving on, we have our new capital section, as I mentioned, did not change. In the month of March, we'll be focusing on a recommendation of engross and items to be maybe pulled out to have a further discussion on. but our items to date over $50,000 still remain the same. Palm Ridge Pool Paint and Area Interior for $75K. The Beardsley Mini Golf Shade Cantilevers for $50,000. In the R&R portion of our budget, we still have the $892,874 for the R.H. Johnson pin setters at the Sports Pavilion. 2 oiling machines at $62,348 each. Primarily the gutter systems are $53,072, but in gross, all the items that are needed to make this improvement, including division capping, the ball track, the bumper system, and foul lights, I've included that so that we are making a informed decision on not eliminating any one of these items, but getting approval as gross, and then the masking units for $26,000. We also have the R.H. Johnson tennis courts windscreens for $75K. The Kuntz Fitness cardio equipment replacement every 5 years for $208,319. And then the new ad that I mentioned of the Rec Center's AEE devices, a quantity of 42 for $68,000. This new ad came about as the manufacturer sent our safety department a bulletin that they have a new written useful life that they need to make clear to the communities that purchase these AEDs, and that life has been given that these AEDs need to be replaced every 10 years. That was a recommendation before. Now it is a bulletin of absolute that is their recommendation as the manufacturer. So we have 54 devices, and 42 of those are already beyond 10 years old, 10 to 15 years old. Availability of using built-in Wi-Fi enabled technology is a benefit of these new devices for real-time visibility, tracking, and monitoring of the machines. That's just a bonus in the new features that come out in the devices that would be purchasing today. And this cost includes a trade-in value on those 42 units of $6,800. And then when it comes time after approval of this budget, we have a potential for alternate supplier vendor costing. So we will do our normal, go out for bid and see if we can get a better value from a different supplier. Otherwise, this particular brand is what is our recommended industry standard for AED machine. So moving on from there. There are no specific changes to landscape and golf items. So just to help Todd out, there are no changes. We still have items over $50,000 in the lawn bowling project for $337,459 for replacing the 2 lawn bowl greens. Yes. Todd, come on up. Todd's going to take over and represent golf.
All right, good morning. Yeah, just to give you a little more detail to the renovation that we're proposing at the lawn bowl greens. We're looking at regrassing greens 1 and 2. They are the original greens. They're over 40 years old. They're past their useful life. With this project, we'd remove the existing grass along with about 6 to 8 inches of root zone mix. Each green is about 14,400 square feet. So if you add that up with, let's say, 6 to 8 inches of root zone, that's a lot of material that we're going to generate. So I'd like to note that that old root zone material can be used for the shoreline projects over at Deer Valley and Desert Trails in 2026. We would regrass with a sod called Tiff Eagle Bermuda grass. It's been proven, it's very successful. And again, we're going to get at least 40 or more years out of that too. So we're excited about that. The cost of the project, $337,459, or if you want to break it out per green, is $168,729.50. And again, our start date, we're looking at April of 2026 with that project. I'd also like to note that during this project, we would replace the plinths if they need to be. Those are the the boards that support the sod around there. And we've replaced those about 10 years ago. It's treated lumber. So I don't know the condition of those. They may be good, so we could reuse those, but time would tell once we dig those up and inspect those. And if we need to replace those, there's money in that dollar amount to do that.
We had a bunch of questions at the last meeting. Any questions remaining for Todd about landscape maintenance?
I asked a question last meeting, that, Todd, I know you weren't here. These are original, and we've never replaced them, and your crew has not replaced them. Right? They haven't done this work before. I would imagine it's when I first read the price, I was like, ooh, wow, that's pretty expensive.
Yeah.
I don't know how much is material, how percentage-wise. So is it a heavy material cost, or is it a heavy labor cost?
A heavy labor cost. We're going to outsource this to a company that does this. We would help assist them in removing some of that material, or hauling that stuff over to the landscape department and stockpiling that for those shoreline projects that we have in 2026.
Okay, actually, the root of my question was, are we outsourcing it or not? And I thought we were not.
Yeah.
So, then I said, well, how do you make an estimate when you haven't done it before? But so you've got people who've done this before,
Yes, sir.
and therefore our estimate's probably somewhere in the right ballpark.
Yes, sir.
Great, thanks.
You're welcome. I'd also, if I could, real quick, you can see the picture there in the center of the U.S. Open 2024. We did host the U.S. Open this past year, and I think in the future we'd like to host more events. I mean, I think that's good exposure for Sun City West to have that event. People from all over the country and sometimes all over the world come out here to Lawn Bowl during that event. So again, it's a good exposure for Sun City West.
That was. Thank you.
Yeah, if you want to go through it, you have
Do we have a few more? Just key changes. I think we got most of this. So
Okay, yeah, there's no changes on that. I did want to point out, going the right way. Yeah, just a few changes on the deferred and eliminated. You can see we deferred one unit. It's a Procore greens aerifier for $41,000, and then we actually eliminated one unit off of the reserve study that was a fairway aerifier for $34,000. And then in the vehicle replacement for golf maintenance, one unit was eliminated. That was a dump truck for $74,000. And then landscape maintenance, we had 4 units that were deferred: bank mower, tractor, utility trailer, greens roller for $140,000. And then 1 unit was completely eliminated from the reserve study at that time. So the total, my glasses to see that. Yeah, I'm sorry, get my glasses here. So the total deferred and eliminated is $345,831 for the golf and landscape division.
okay. That is very small printing. Okay. Very good.
All right,
So those
thank
are
you.
the key changes. And we'll hold on just a moment for those questions until we're at the end. Any other key changes there, Paul?
No other key changes,
Okay.
including Todd's, Pat's golf ops division items. Sorry if I'm going backwards. And finally, no changes to allowances. So if you have any questions.
Okay. It looked to me, Carl, when I was totaling things up really quickly, then just our new, and we have a lot of repair and replace in CIP next year proposed, and the total for new, which would include these allowance categories, is $710,000 in new capital investment next year. Did I have? Does that seem about right?
No, that's.
If you lump those together, that number would be correct. I will say that the allowances, generally speaking, are repair and replacement items that come up.
So from
Throughout.
going back to our previous discussion about modeling, although that number is included every year, next year is proposed to be a relatively small year in our model, okay? By lumping those together. It doesn't really include new, but it's not something that's technically repair and replace, so thanks. I won't poll unless we need to. Any committee members, just a quick nod of the head if you have any questions on the changes, not on the numbers, but on the changes. Okay, then we have one resident that already has a question. If there are folks online, please type those into the comment box. This is your time. So, Mr. Turner?
Yeah, hello again. Nick Turner, 131829. I wear many hats here, as most of you know, and the hat I'm wearing at the moment is as the president of the Lawn Bowling Club. And I just want to give you a little bit of information about the club, because I'm sure very often when you drive past there, there's nothing happening. We have a world-class lawn bowling facility here. When visitors come in who are playing tournaments here, they continually tell us that. This is really good. We had a reciprocal yesterday with Pueblo El Mirage. 2 of those members asked if they could join our club. Unfortunately, they can't. We had the similar questions from other competitors who've come in. But this season, we're going to be, with the season from November through to March, we will host or will have hosted 8 regional or national tournaments, and as Todd said, that includes the US Open. It's a great advert for the community and for Sun City West. The total number of tournaments that are going to involve 23 days of play. There's one starts tomorrow. The South Central Division of the United States are playing their men's tournaments here the week after that. We've got 6 days of play coming up, and imagine 6 days of play on those greens. We try to move people around the greens, but that is a lot of wear and tear. If you add to that the club fun days, and other competitions, skills training, social events, and so on, we actually use between November and March those greens for 242 days. That's equivalent to 2 activities per day over 5 months is actually going on at that club. So it's a busy club. It's an active club. This is a once every 40-year cost, and the money is already in the reserve fund. That's what the reserve fund is there to finance these activities. So again, there is nowhere else like this in North America, as was said to me by a competitor at the US Open. Thank you.
Thanks for the commentary on the reference to other clubs, and I think it's important to note for all of us wondering, this is the first time in our association's existence that we've made this level of maintenance on lawn bowling. It's not something that we expect to occur on an annual basis, so thank you. Anything else?
Any other questions?
Seeing none, and none from our residents, thank you again, Carl. We'll be seeing Carl again at every one of our meetings to go through. So I do know I usually call for a break at around this time, but we only have one more agenda item left, so I'm going to power on with the agreement of the committee. So we'll move on to 3.05. This is just a quick recap of some of the key things that we can expect to see happen going forward, because we're now in the throes of our budgeting season. So at the start of the year, back on our September 3rd meeting, I presented the roadmap that you see here in front of you. I made a couple of small clarifications, but the first is that big red arrow. It's red in our presentation, right? But the big arrow shows you are here. So we're in early February. We're most of the way through our working year, if you will. And we've been very busy, but now the pace picks up from a budgeting standpoint. We started our capital budget review, and I believe at our next meeting, we get our first glimpse of the operating budget. Operating budget is the crux of any changes to our dues. We all know how near and dear that is to all of our hearts, but together, capital and operating budget will be a big focus, not our sole focus, but a big focus of our time together over the coming months. So we've started our capital budget. We'll see our first glimpse of the operating budget. I get very excited about these numbers, you know. So first glimpse of our operating budget will occur here. and the governing board and so forth. So that's the first line is all about budget. And then if you move down in that roadmap to the second line down, we're talking about policy reviews. The policy reviews are substantially, a lot of them have already taken place from a content perspective. As we know, we have 3 more policies to continue to formulate our recommendations on. We will complete FY10.
That's right.
Gosh darn it. So we expect to have most of our policy red lines complete in the month of February. Our investment policies, of course, as we know, this is going to be more substantive and independent of any changes in the investment strategy. There are a couple of policy changes that are undoubtedly going to occur. So those red lines will need to be complete by the end of our time together, which is May. Every quarter, the next line down, every quarter we get our investment reviews. So we heard from CapTrust today about what was occurring in Q4. We'll hear our Q1, if you will, calendar Q1 review coming up in May. Last but still an important part, not least, of what we do, we review some of the upcoming renewals that our operating team is going through for insurance. So we've already reviewed our health insurance policy review. Next up is workers' comp. I'm not sure if that's coming up in February or March, but we'll have March. So workers' compensation insurance policy, and then the rest of our policies, which I've lumped together to call P&C or property and casualty. But all the rest of our insurance policies will see that renewal coming up at the end of our working year together. So that's where we stand from a roadmap. And if we go to the next slide, this is what I just wanted us to keep on in our eye on. We have some key dates coming up, and just wanted to make sure we get our first review of the operating budget on February the 18th at this committee meeting. By the end of March, so we have somewhere around 6 weeks left for us to recommend any projects that need to be pulled out for special review by our governing board. I reviewed this term pullouts last time, but just to repeat, we use this shorthand term to say, rather than recommending an engross approval, these are the items that we recommend the governing board review with more clarity. Maybe it's something that we feel needs to be removed. Maybe it's something we feel needs to be bulked up, or maybe we believe the entire capital budget is okay. Whatever our recommendations are, no later than April 1st. But to be on the safe side, I'm targeting for us to say March 18th. But again, if we have other changes that have come up by the end of March, then we may need to take one more final review. Just keep that in mind. Our investment strategies that we're talking about here, not the policies, but the strategies that we talked about, Mickey and Rick's work on the strategy, we will need to solidify a recommendation based on governing board feedback, resident, owner, resident, any input, so forth, our collective recommendation on the strategy by April so that any policy red lines and changes can be completed for recommendations by May. May 20th is a very firm date because the governing board final meetings will occur in early June for a workshop and then a recommendation. So we need to keep an eye on that one. I know how important this is. We've worked very hard on it. So keep an eye on those dates as I am. Any other recommendations, because we've spent some time talking about this, David and I and a few of us have been talking about making some recommendations around overall improvements on our FI policies and FI governance, financial policies, financial governance. Recommendations for improving those that we will need to be carrying forward. Those will also need to be made by the May 20th meeting of this committee. Keep in mind our final governing board workshop is June 13th. That's the reason why we need to have our recommendations solidified for the review of the governing board so they can be positioned to make any decisions on those recommendations by the end of their working year. The final meeting of the governing board is in June. So that's where we stand. Questions on those target dates? It doesn't, again, it shouldn't matter to the rest of us, but just so you understand the busyness and the big rocks, if you will, the big dates that are coming up for budget and finance.
Just a couple of other key dates.
Please, sorry.
So this week, we have our sports pavilion and golf committees will be discussing our comparative rates for bowling, and golf. So I encourage you, if you can't attend, to watch those online, because that'll give some context to what we're going to recommend for the budget in terms of rates and how we compare. So there's that. And then on March 12th and March 13th, the next sports committee meeting and golf committee meeting, we will give a presentation on their divisional budgets. So it'll help give some context to the overall budget, which you'll see, but you could see some details regarding sports pavilion and golf specifically in those divisions at those two meetings. So if you want to attend those or watch them online, that'll help the process.
The 12th and 13th?
The 12th and 13th. Sports pavilion on the 12th and golf on the 13th, where we'll present their individual divisional budgets, which will be rolled up into the overall budget, which you'll see in February, March, and
Excellent.
April. And
Thank you for that reminder.
one other point of clarification, and you may have said, but I just want to be clear, the governing board votes on the budget on May 20th. So all the budget stuff has to be done prior to May, well in advance from our
Right.
perspective, and we'll be presenting that. So just want to delineate that between June 13th and May 20th.
Oh, thank you so much. And again, these are Budget and Finance Committee dates, so thanks for that clarification, Cliff. Our recommendations on pullouts and operating budget recommendation really must be made by the end of March. That April 1st date, that will be our first, it's not a joke, that will be the first meeting in the month of April for Budget and Finance Committee. We should be targeting our recommendations by the 18th unless we expect a substantial change between then. We have no later than April 1st. This is, again, these are very firm dates. And without that, we won't be able to have those debates and decisions by the governing board. So our recommendations are important. Keep those in mind. Any other clarifications or things I missed?
Nope.
This is important.
And community forums will be on the 20th and the 21st, I believe, morning and evening. And so we definitely want to have this budget baked by then. So another good reason to have everything from our perspective done by April 1st.
Yes. Those are April 20th.
Yes.
Right.
Sorry.
Okay. I just wanted to make sure. Okay, very good. Thank you so much. So those are our key dates, and we'll move on now. Any last committee comments? So I'm going to actually start with John Click, because we always start with the ends, and the two people sitting on the ends get all the focus. So we're going to start with John.
I actually do have a comment. And listening to Nick talk about the lawn bowling and use the term world-class, I'm going back to a bowling presentation we had a meeting or two ago and hearing our individual talk about, we have one of the best bowling alleys
Mr. Zarek,
in the state. Thank you. I walked on the properties and walked on the softball field and said, this is like a Major League Baseball field I'm walking on. Our tennis facility is gorgeous. I'm a pickleball player. Our Liberty courts are gorgeous. We hold a Fun in the Sun tournament coming here in March, and last year when we ran it, I got comments that this is one of the best tournaments for pickleball in the area. I already knew our golf was fabulous, and that's why people move here. So I'm just continually impressed with the recreational experience we provide for our community and the facilities that we have. And I do hear us talk at times about they're for our community members. And I was really happy to see Mickey put in her presentation, and Rick, sorry, the caveat that, and future members. And I think it's just really important that what you did with national, what was it, the national tournament or the US Open, thank you. And when people are coming in and seeing the level of play and the facilities we have, it's a great advertisement for our community and helps us as homeowners.
It does.
For the value of our home. So I'm continually impressed with the facilities we have. That's all I want to say.
Thank you, John. Jim?
Thank you, Mickey and Rick, for your presentation. Overall, great meeting, and I second your sentiment as well. We have a world-class community here, and I think everyone's doing a fantastic job of keeping the train on the track, and yeah, thank you.
Mickey?
I did really appreciate Nick's comments, because I think that sticker shock on, hey, that's a boatload of money for that little lawn, right? And so I think that was really great to have you, just put it in perspective, right? Put it in perspective, and also because I have to really echo John's comments. My husband and I have been here for 5 years, and from the moment we came here, we were just amazed by the quality of the experience. And yet, it doesn't mean that you understand every experience. So lawn bowling, I don't understand that experience. And so I really appreciate that feedback.
Thank you. And for anyone who may be watching who isn't here, you'd be welcome to come to a future meeting. It's these large items. If you feel like you want to give us a little bit of context, you'd be welcome. Just know that the committee members have had the opportunity to walk through and see firsthand our properties, and we've had the opportunity to assess some of these and to talk to our other committee members on properties, on sports pavilion, and recreation and so forth. So in any event, thank you for that. And if you're listening and you want to make the same sort of clarification or pitch, you're welcome to come to a future Budget and Finance Committee meeting. Ed?
Two things. I'm kind of big on continuous improvement, and I think that we're doing a good job looking that even though we are in the top 5 or 10, 55 plus communities, we're always looking ahead. Don't sit on our laurels, because places that do that, private, public, in the end, it doesn't work. So I'm glad that we're trying to be ahead of the game and be more proactive rather than reactive.
Thank you. Great comment. Rick?
The only comment I had is I look at the dollar amount we're putting into the sports pavilion, and it's great to see that we're putting money into a organization in a facility, and it's the same amount we're putting into golf operations. So that takes the pressure off all the golf operations. But on the second thing, from a personal standpoint, that's a lot of construction, a lot of maintenance, and a lot of things to be done in that sports pavilion. And will it be done on time? And will it have an impact on the leagues, the revenue that we generate from there? Just all of that.
We don't need to answer the question. Go ahead. Thank you.
It's just that it's such a big investment, and the timing of all of that, and the use of the facility. Is it reasonable to admit that we can do that on time and within budget?
At this point, the reason why I said we don't have to answer the question is a great comment that I'm sure you can answer in our next meeting when we go through the amounts. We have talked about that in past meetings, so you can go back and see a little bit of that. And if there are remaining questions, I'm sure Carl can walk us through it, if that's okay with you, Carl. Okay. David?
The only comment I have is related to the ability to have outside regional or something like the US Open, as you mentioned, Nick, to come in here to our community. I would hope we'd have some way to either measure or to promote our local businesses within the community, because the downstream effect can be significant, coming to restaurants or other things. Ultimately, that affects our lifestyle, because then we have these businesses that still remain here to keep in business, and it makes our lifestyle easier because we don't have to go outside the confines of Sun City West. So I don't know if we've done that in any way, but when we have these types of activities, some way promoting the businesses within the community, I think would be really a great opportunity for us to support our community.
That's a great suggestion. We'll make sure that we pass that on to the event organizers. And I know that there are considerable efforts that go in to some of that outreach, and the Torch Committee reviews some of that as well. But I think that is a great suggestion that we can pass on. Thank you. Chris?
I just thought it was a real good meeting. It was informative. I enjoy this. My wife's not here for a reason, because she would not enjoy this sort of stuff. But if you're interested and you'd like to see some of the details, I think this is a great meeting. Thanks.
Yeah, my husband's not here, Chris, for the same reason your wife's not here. And it may not be to everybody's taste, but we're all, I always use the metaphor, we're business partners, right? All of us who live here, we've made an investment in this community, and we're investing in something that we expect to see endure for far beyond our years. And that's the big difference for us on the Budget and Finance Committee. We're numbers people, and we love this stuff. Our next challenge will be to distill it, although it was extremely clearly presented by all involved, in my humble opinion, to distill it even further so that Chris's wife and my husband and everyone is just as excited about this as we are. That's a big challenge, but we'll continue to do that, and we welcome everybody's input. So that's my feedback. The other piece of feedback is that while we don't have a projection in the room, I actually feel like it was so much nicer to have you all sitting closer, and it felt more conversational to me. So thank you all for being here and so forth. I don't see any other questions online, but are there any other comments in the room? Okay, we have an unknown resident stepping to the microphone. We welcome you all, but seriously.
It's very difficult to shut me up, I know.
No, we don't want to do that. We want to hear you. So
Yeah, I'd just like to add, I didn't mention it in my previous 2 minutes, is that one of the reasons why we have a world-class lawn bowling facility here is because of the work of Todd and his team. We have, if you like, dedicated members of his staff who know what they're doing when it comes to looking after those greens, and I do know that Todd spends a lot of time there as well, making sure that things are all right and that things are going well. And the other thing I'd like to add is that this is a little premature because the club membership has still got to take their vote to approve or disapprove the acceptance of it. But Bowls USA has asked if they can come and host the US Open again this coming November. It will be shared across Sun City like it was last year, and also I believe the Grand is taking part this year as well. So if our membership says yes, we'll start working with the recreation centres and so on that, and then we'll see what we can do about other local things happening, because one of the things I could think of is just Puerto Rican Pete's food truck could set up at that side of the car park and things like that, because we do have a lot of people attend these things. The most recent tournament a couple of weeks ago, there were 75 people out there, bowling at that tournament. In the US Open, we have even more greens in use, so there's even more people there.
beautiful. Thank you. I love when suggestions are immediately taken. Any other comments or questions from any of our attendees or staff? Seeing none, the time is 11:28, and I waited for that timer to turn, and this meeting's adjourned. We will see you, I forgot to mention, our next committee meeting, we're not adjourned. Our next committee meeting is February 18th at 9 a.m. right here, same time, same place, and now we're adjourned at 11:28. Thank you.